All right, we're going to get started. Thank you so much, everyone, for joining us tonight. Hope you're all doing well and feeling well. Tonight, we're going to have our first of the 2022 roundtable season. So thanks again. Tonight, we're going to be discussing the Fannie Mae and Freddie Mac 2022 lending guideline changes, which is going to impact the condo and co-op property market. So definitely helpful for you all to hear about. I'm just going to do a brief introduction of all of our panelists joining here tonight. I guess foremost, my name is Elise Rosemarin. I'm a Senior Vice President here at ACAM. Joining with me tonight, we have Jack Lepper, who is a partner, a managing partner of KLL, which we can also abbreviate. I did it. He maintains expertise in the budgeting of capital projects and related financing and is valued for his negotiating skills and practical approach to financial construction, regulatory, and general corporate issues. So thank you so much for joining us tonight. Oris Tomaselli is the president of the Condominium and Cooperative Review Division at Condo Tech. He is also the owner of Strategic Inspections, a national reserve study firm. Oris and his team have provided thousands of buildings with reserve studies through strategic inspections and enabled Fannie Mae, Freddie Mac, FHA, VA, and portfolio project approval, and thousands more. Thank you so much, Oris, for joining us tonight. Mark Tamris is the founder of and CEO of Home Run IQ, which delivers cloud-based financial tools for multi-unit properties and their provider partners. These data-powered tools improve property financials, reduce total costs, and mitigate risk. Mark is recognized as an industry thought leader and is a select member of the CAI Foundation think tank and is published in various journals and presented to national audiences. So thank you so much for joining us tonight. We really appreciate it. And last but certainly not least is Ajo Kurian, who is our very own Senior Vice President here at ACAM. I'm sure many of our boards have interacted with him, and he will also answer on behalf of ACAM strategies behind all this. So thank you, gentlemen, for joining us tonight, and we'll get started. So we're going to do a brief overview and discuss what's happening today. And then at the end, like we always do, we'll have a Q&A session. Please throughout, feel free to put your Q&A in the chat, in the Q&A box at the bottom of your screen, and we will definitely address them in a timely manner as possible. But definitely we will answer them at the end of tonight. And if anything goes unanswered or you forgot to ask a question, please let us know and we will get back to you as soon as possible. All right, thank you so much. Let's get started. So what is happening? Mark, we want to kick it off?
Sure. So look, I think many people have heard about the tragic collapse of what happened at Surfside, in Surfside, Florida, the South Champlain Towers collapse in early July. It was a terrible loss of life, and it was a horrific incident for us to witness. But what it's created is responses and ripple effects nationwide, and those that are affecting regulatory and legislative environments and underwriting. For full disclosure, I was part of several task forces with the industry talking about the ramification insights from that tragedy. What we're going to be talking today are about things that are already rolling out with regards to lender guidelines that are impacting all the condo and co-op unit lending. It affects underlying mortgage availability, insurance, mortgage lending warrantability nationally. Whereas I think can talk to great detail about that. But just want to point out that this is something that, despite what happened with the tragedy, the markets on lending and risk management practices were already tightening. This is not something that was just triggered by this tragedy. It was accelerated, and it's just going to continue to bring on other activities. So, Oris, would you like to give a little color on what's going on with Freddie and Fannie?
Yeah, so the two national insurers of mortgages throughout the United States that represent more residential mortgage financing than any other group are Fannie Mae and Freddie Mac. Essentially, they insure the lenders, and they have specific guidelines that most, if not all, lenders have to align with. There are some lenders who have other types of lending guidelines, portfolio lending guidelines, and even those lenders are now aligning with Fannie Mae and Freddie Mac's new guideline changes. So these guideline changes, were released between October and December. Most importantly, Fannie Mae going forward and starting their guideline changes on January 1st. And Freddie Mac is going to follow them on February 28th with implementing their requirements. But what should be known, what we're going to outline here today, is really what these guidelines mean for condominium cooperative boards. There is a complete departure from the way condominium and cooperative buildings were looked at in the past, as opposed to how they are now looked at today, and what requirements are for boards and managers. And there is an incredible amount of increased, requirement for boards and managers to make, statements, and in our opinion, create liability for themselves by making those statements about the structural components in their development and what their condition is. So these guidelines are impactful across the board. They're going to change mortgage lending across the board. Many lenders have implemented them already and have started to implement them in December. With these changes on January 1st, and you will see that many loans are going to be rejected based upon condominium developments that do not comply with these guidelines.
So what are, I guess kind of going back, what are some of the things that might change though, that might have under the old way of functioning? What might have changed for people that are in application mode?
So Elise, if I may. So good evening, everybody. So I appreciate that our audience, I believe, is largely board members, but maybe other people as well. And board members are always charged when they're elected with quality of life issues for the residents in their building, for maintaining value, of course, and also for watching over costs. And so, what do boards do? They always function and concern themselves with what are our operating costs year to year, and how do we keep those operating costs as low as reasonably possible. And what can we put off? And what we tend to put off historically has been capital repair and capital budgeting for our buildings. And as a result of what happened, as Mark explained, lenders are no longer going to allow this. And so you as board members, as managers, are now forced with having to address capital work and capital budgeting in a way that was never done before. And you must consider this in connection with your refinancing, with local laws that are coming up. Otherwise, very candidly, people who want to buy into your buildings as either a condominium unit owner or a shareholder, or people who are living in your building who want to refinance, are going to find that many, if not most banks, are going to say that your building is ineligible. And I think that through this discussion, you're going to hear what you need to do as a board to minimize that problem. And it's not tomorrow's problem, it's today's problem. A little bit of good news. Where in the past, everybody wanted to avoid such work and capital improvements to keep costs down in order not to lose political favor. Now you're compelled to do this. And so you have the support of the lending institutions of our country that will require that you take certain measures as board members. And I believe, as Aris may have said, you're required to make certain representations to these lenders as volunteer board members. And we're going to discuss that as well, and how you can avoid pitfalls and trouble in making those representations.
And if I may, one of the things I'd like to add as well is that when you think about what is happening, in particular the impact to the board owners and the management companies, it's really aligning incentives that may have been able to have been a little obfuscated before. This is really aligning your long-term incentives with your short-term incentives. The idea of potentially paying less today was there was a little bit of a feeling that maybe some of these costs were discretionary. But one of the tragic elements that was shown within Surfside, unfortunately, was that these not only have costs, but they have risk. And this risk could be tragic and consequential. So not only are the underwriters on the financial side, but insurance companies are starting to take note. So what it means for the boards and what it means for management companies is that you have to look at the infrastructure and the engineering strength and structure of the property, in addition to the fiscal plan, and that those things have to align. So there's no longer saying, I'm going to kick the can down the road, both the work and the financing. Now people are saying you may need to think about how you're going to finance things today and have a plan to go forward.
Yeah, so in following up with what Mark is saying, where in the past people typically focused on their operating budget and the items within their operating budget, you now have to have a capital budget and plan that coexists. And in fact, your operating budget, and I'm sure Horace and Mark will get into this in more detail, is going to require that contributions be made towards that capital plan on a yearly basis. So many co-ops and condos are going to have to adjust their operating budgets to address these guidelines.
So speaking to that, someone's asking if they're already working on a capital plan for anticipated financing, then what are the additional requirements they should take into account given their capital plan now?
Now, I mean, the first and foremost is Fannie Mae and Freddie Mac issued these guidelines, and they've always kind of existed, but there were so many ways for loans to be performed in condominium and cooperative developments and not necessarily comply with these guidelines, but that's all essentially gone away. So one of the largest issues and what we have to be thoughtful about as boards is to include either a 10% reserve line item in the operating budget, and that is a yearly collection of 10% of that operating budget. In some cases, that could be lots and lots and lots of dollars that get set aside into a separate account for reserves for the reason being for repair and maintenance of common area components, structural components, of course, included in that. So that's one of the major things that's changed in these guidelines.
And to add a little,
I'm sorry, Mark.
no, go ahead, Jack. I'll follow.
Well, that was an understanding that many condominium boards had over the last couple of years. I believe it's now applicable to co-ops as well, correct?
Correct. So there's always been this, guideline within Fannie Mae's guidelines that, again, all lenders are following now, that is stated that a cooperative development had to have an adequate amount of reserve. And while that guide,
which is always interesting, because whenever we went on interviews, people would always say, well, we have 2, 3, 4 months of reserve, which is the industry standard. And I would look puzzled saying, what does that really mean? Right? What does that really mean? Also, historically, when buildings are refinancing, they often get engineers reports. And I think that a lot of boards think that if they get the engineering report just that the lender requires, they're satisfied. But Horace, can you explain a little bit the difference between the kind of a report that you would provide that will actually meet these guideline requirements as opposed to what an underlying mortgage lender may require?
Sure. And to your point, a lot of underlying mortgage lenders are now changing their guidelines requiring reserve studies. So an engineering report is a fantastic report to have, right? You can focus in on specific structural components in the building, focus in on, whether or not they need to be repaired or maintained and how they should be repaired or maintained. And in many cases, assess a cost to those components. But what an engineering report doesn't do is provide a lender and a board and an owner with an understanding of what the repair and replacement costs are going to be over a 30-year horizon. So not what it's going to cost me right now, but over 30 years, which is the lifespan of most mortgages, what are the increases to reserve contributions going to be? What are the components that are going to fail? What is the cost of replacing or repairing those components over that period of time? And the reserve study, it also includes an interest rate calculation, which essentially outlines what the reserve account's interest will be over that 30-year horizon. And it also has, more importantly, an inflation calculation. How much are these repairs going to cost 10 years from now? And that's what engineering studies essentially don't do. So what most boards, I think fail to understand is that they, and not from any, malice, but just that there are definitely reports in the industry that are utilized across, the spectrum of lending, insurance, that, there is, and that is the reserve study that's going to be necessary to get performed on these developments so that they can establish an appropriate reserve account. And, the bottom line is this, and I think we talked about this before, Jack, not during this meeting, but the way New York City, as an example, has funded reserves or funded repairs and maintenance over the last 40 or 50 years has been to set up a special assessment. And they identify a problem and they want to do a repair, and they create a special assessment and divide it by amongst the unit owners. And once that money is in the account, they do the work. Well, the agencies don't want that to happen for obvious reasons. They don't want to put, a financial burden on homeowners that possibly can't afford that special assessment. And they want to ensure that in the, when a loan is being qualified for, that the appropriate amount of capital maintenance, is being, determined in the qualification of an individual for a mortgage. So the only way to do that is to get a reserve study and make a determination based upon the actual cost of the repairs and maintenance.
Yeah,
And to add a little color to that,
yeah, Mark, go ahead.
but yeah, I was going to say is that, and I think for the average board person, the way I would like to frame this up is when you made the great distinction about OPEX versus CAPEX, or operating expense versus the capital budgeting. When you're doing your budgeting exercises, typically a board might look at the 80 line items that they have from the OPEX, and then there's a one line item for capital budgeting. It almost should be reversed in the sense with regards to the amount of effort and diligence you should be putting in the capital budget. Because an operating budget is really an accounting exercise that you can look back at 12 months what your operating expenses were. The plan, and to reiterate what Orr's saying, is the capital budget is a 30-year forecast. It's a financial forecast, akin to your financial plan like retirement. You're looking out 30 years in the future for potential risks and obligations. That's how underwriters look at it from the financial side. That's how insurance companies look at it from the likelihood of fail from the age of the building. So the thing that's really important to stress, and to reiterate what Orr was saying, and I think Jack, you were talking about, is the board is making a decision to pay for its bills today, but how it will finance its future. And you finance your future through the inflation interest rate against the obligations in 30 years. And so that is a non-trivial exercise, but it's so critical. And now Fannie and Freddie, as well as the insurance companies, more so going forward, so expect to see more about this, will be aligning the incentives from the board and the properties to de-risk the long-term from a financial and an underwriting perspective. So make sure that you have that capital plan to cover those obligations as they come forward.
So
I guess,
so
Orr or
I'm
Mark,
sorry,
I just had a quick question on the and clarification with regards to the reserve study. How invasive is it? Like, we know that the local law 11 inspection is what it is. What's the difference between that, and how invasive do you get to this reserve study on a structural basis?
That's an Orr's question.
Either one of us can answer that one.
Yeah.
Mark, you want to have at it, or?
Mark?
Sure. Well, I'll start off. Look, the reserve study is a great and powerful tool. It is not universally and uniformly applied. I would say, from Orr's perspective, they have a leading product which allows to go deeper into the analysis. But what a reserve study typically does is look at those predictable items that you can plan for over 30 years. There's local law like 11 with regards to facade that require engineering inspections. A strong reserve study will acknowledge that there are things that go that are structural in nature and that may require inspection and that follow local laws. So depending on how the reserve study is practiced and the work that's done, at minimum, it should be looking at the core components that are observable. It should be looking deeper into the analysis of the property that gets a little bit more at surfacing where there could be structural issues. If something gets very deep in terms of the analysis, let's say there's a key issue, and this was true of Surfside, they had concrete spalling within the infrastructure. That required an engineering analysis. But a reserve preparer and a good reserve analysis would have signaled that to the board and then flagged a potential inspection cost and further work that needed to be done.
Yeah, and just to add to that, so a normal reserve study, essentially an engineer goes to a property, looks at all the common area components within that development and assigns a value and a replacement cost to every single one of those developments. So if nothing else, and I talk to boards on a regular basis, we've done thousands of these studies in New York City already, it gives board members an outline of every single common area component within the development. How many fans the development has, how many cooling fans, how many, how many risers in the building, and it really looks at the mechanical systems as well as, down to the paint and the carpeting in the hallway and when that has to be replaced. So all in all, it's probably one of the greatest tools for a board to utilize to make a determination about, how much money they need to set aside going forward.
And just to give some general perspective, and bring things back home, what we're essentially saying is that Freddie and Fannie have now said if anybody wants to borrow money in your buildings, Okay, we're gonna do a comprehensive diagnostic of your building. Okay, we're gonna look. And frankly, if you don't have the information we need to look for, we're gonna assume it's bad. All right, we're gonna assume we have problems, and you're gonna be not an eligible building for a Freddie Fannie. Your residents will not be eligible for a Freddie Fannie loan. And if you have significant deferred maintenance, if you're putting things off, we're gonna figure that out. And we're gonna look at your minutes for the last couple of years, maybe 6 months or longer. We're gonna look at your budget. We're gonna look at your reports. We're gonna look at everything you got. And we're gonna make a determination whether we think you're acting in a way that we find responsible. And if not, you will become an ineligible building. And you're gonna be put on a master list. The name of that master list is what? The condo project manager list? Is that right?
So it's found within the CPM condo project
Yeah.
management system, which all lenders have
And
access.
we don't care how wealthy you are, or your parents are, how much money we don't care. If your building is earmarked as ineligible, you're out. And so this is something that all boards really have to deal with now, because if you can't get a Freddie or Fannie back loan, which is now up to just under $1 million, guys,
Not yet, 970,800.
very close to $1 million. If your building is not eligible, you may have effectively devalued apartments in your building. All right.
I'm gonna go, I'm gonna go a step further on that too, Jack, just because. So one of the biggest things that came out within these guidelines, and we really do want to get to what the guidelines are and what we can do about them. One of the biggest things is this new unavailable status that Jack is talking about. So the agencies got together and said, okay, well, how do we essentially make sure that if we identify a problem in a building, or if we can't get the right information in a building, that across the board that we won't lend in it, and that lenders won't lend in it. And they created this unavailable status since October 15, or since the beginning of October, when Fannie Mae released these guidelines. I think it was October 14th. There have been 942 projects across the United States of America that have been added to the unavailable list. Now, that, across the United States doesn't seem like a big number, but it's a giant number, actually, because to be able to add all of those sites onto the unavailable status list, we see the direction of what's happening. And we really think that there are a lot of projects based upon just our experience of, the New York City and Florida marketplace that are going to be added to this list. What's interesting,
you want to discuss, Mark, maybe what the significant deferred maintenance and unsafe conditions are that Freddie and Fannie are talking about?
Yeah, well, I can add a little bit I'll add to that, and I just want to add one comment to what Boris was saying to build on both your points. Look, I think when people should be looking at what, in particular what Fannie and Freddie are looking at, or the significant deferred maintenance, are the things that ultimately could create special assessments. So imagine that in a few years' time, you have a significant capital repair, replacement, or improvement that could be significant beyond, let's say, normal dues, and you would require a special assessment. They are looking at two things. They're looking, number one, do you know what that is? Do you know what your obligations are in the future? And secondly, are they funded? Are you collecting enough monies today to finance that obligation? Or will it fall under special assessment? And if they feel that you have significant special assessments or unmitigated, or I would say unfunded risk, that's number one. Number two is if they have significant deferred maintenance to the point that it creates a liability or risk on the building in terms of its structural integrity. Like, is there a concern of health and safety issue related to that property? Those are the two primary issues. I'll let Oris add to that, and then I'll come back to the financial incentives of why people should be taking care of that.
Yeah, so these new building, thanks, Mark. These new building, level requirements are, as we've outlined, the 10% reserve line item that is now essentially required for condominium developments, or obtaining a reserve study to show what the actual amount of reserve should be. So if you look at the average in New York City as an example, we've pulled these numbers a couple of times. Most buildings are averaging out to around a collection of around 4.2% towards reserves, which is, woefully shy of this 10% requirement. So the reserve, but every building is different. And there are buildings in New York City that have large, capital accounts, and may not have to or shouldn't have to reserve this 10%. We run across that quite often, actually. We just did a building recently where they had a $22 million slush fund, essentially, sitting in an account that, you know, was for a rainy day. And buildings like that are financially funded and funded very well, and are likely not to require an increase in their reserve contribution. But there are far more buildings that don't have that buildup of cash or enough cash for the repairs and maintenance that have to be you know, performed in the near future. So that 10% reserve line item is one requirement.
Sorry to interject really quick, Boris. Can you just state what the 10% is of what? Because several people have asked. Thanks.
Sure. So it's 10% of the operating budget. So if your yearly operating budget, you know, is $1.1 million, you have to set aside $110,000 a year as a line item in that operating budget. And that the collection of that, and that should be, you know, titled that, you know, reserve collection. And the collection of those funds should go into a segregated reserve account that's set aside for the, you know, the maintenance and repair and replacement of the common area components in that building.
So, Horace, I was going to ask Mark, for condominiums that are facing major capital work, all right, there are more lenders today than in the past that are willing to finance that work over a fairly extended period of time. And the new guidelines have all these provisions that relate to assessments or special assessments, and how the bank will look at that, and whether it's efficient, whether it's well funded, whether people will be able to pay, among other things. And also, if you're undertaking to work with an assessment, if the work is not done, you remain ineligible. Your building remains ineligible, which is concerning. So here's my question for the board members who are in condominiums. Are condominium boards better off now if they do a report financing the capital work rather than trying to raise the money through an assessment and paying that debt service with an increase in their carrying charges as opposed to an assessment? Or would an assessment for paying off debt service, would an assessment still leave them in the same place?
I'm so taking that question, Jack.
Okay,
We've worked directly with the agencies directly on this point. And, you know, in the project approval process with Fannie Mae and Freddie Mac. And they do view the, you know, obtaining a mortgage as a better plan than filing for a special assessment. And that's typically because the mortgages that are available out there for condominium developments right now, we've seen some that are, you know, available for 20 years. So, you know, you could spread out the payment and repayment of that capital loan, and it doesn't have quite the financial impact of a short-term special assessment.
So one of the challenges of that.
So Jack, let me pile on to Horace for that for 1 second, if you don't mind. The big thing that that this financing also doesn't take into account. I'm a big proponent of getting the capital loans, and just to be clear, versus mortgage, I would say that this is a condo or co-op loan, a capital loan for major infrastructure. Just to make sure there's no confusion. But if you go back in the point that we were talking about moments about the 30-year plan, people have been paying attention to inflation. Inflation's been kind of crazy this last year, but construction and building inflation has been 2.5 times core inflation over the last 20 years. So in many cases, properties are much better off just financially from penciling of this to get the capital loan financed and paying the debt service, because it'll be less than the charge of inflation long-term. So there's a financial incentive to do that. The other point I was going to make is that if you carry these things as special assessments, it doesn't look good for the property, but it's also an unfunded liability. That technically should be taken out of the potential property value. And so those 2 points alone would, I would say, from a fiscal perspective, encourage people to take a capital loan.
So the cost of the debt service,
your comment before,
the cost of the debt service is offset by inflation. So it's
oftentimes it'll be less, depending on the term of the loan. The
practical complication is twofold. Number one, in most New York area-based plans, I can't speak for other states. If you want to take out a loan, it's going to require a unit owner vote, okay, either by consent or at a duly called meeting. All right, so there's certain thresholds that have to be met. So to all the board members out there, you just can't go out and borrow the money. You have to look at your bylaws, work with your counsel and make sure you do it correctly. And secondly, where there are unsold units, sponsor held units, often you can't take out these loans without the holder of the unsold units consenting to that borrowing, and they don't always like that. What's interesting, and based on what we're discussing with the guidelines, for anyone who has disagreed with that approach in the past, the rules of the game have now changed. And so I think this is an opportunity to revisit borrowing the money over a longer period of time to do capital work.
That's exactly right. Yeah, look, those unsold unit shares, holders and those investors who own, multiple units in these developments are going to find and are finding the same guidelines are going to impact them when they want to sell a unit. So to your point, Jack, that has changed dramatically, even over the last 2 or 3 months.
Yeah.
Much more willing to pay attention to these capital repairs.
Forrest, what is the impact on refinancing an underlying mortgage of a co-op with this?
Yes.
Is it going to be impactful?
Yeah, so this is all unfolding, right? And it's all unfolding right now because the guidelines kind of came out of nowhere. We knew they were working on them for a long time, but everybody is kind of in a little bit of a shock after this release on October 14th from Fannie Mae. So everybody's in the process of reacting to it. What we have seen over the last couple of months is that many underlying mortgage lenders now are also requiring these reserve requirements, compliance with Fannie Mae and Freddie Mac's lending guidelines, because at the end of the day, it's going to impact their loan and the repayment of their loan. So what we anticipate, and it's starting to happen, we've seen it from maybe 3 or 4 national lenders who provide underlying mortgages, that they are making these requirements before refinancing and or providing an underlying mortgage to the boards, making sure boards have these established reserve accounts, have established their budgets appropriately, gotten a reserve study. They want to see what the structural components are in these buildings. They want to see that they're in good working order or in good condition now before providing this type of mortgage financing.
And regardless, it's almost irresponsible at this point to refinance your underlying mortgage without taking a good hard look at the issues that Mark and Orest are discussing with regard to these new guidelines. You need to do this because once you refinance, you're typically locked in for at least 5 to 7 years, and depending on your prepayment penalty, longer, and the cost of getting out of that loan is significant and can't be ignored as well. So all this is very timely, time sensitive, and should be considered.
Yeah, and Jack, well stated. And if one thing that hopefully everyone takes away from this conversation is that this is an evolving and changing market. The things that are happening, these are some of the dominoes that have fallen. More will come, and so this is where I think oftentimes capital budgeting reserves was a little bit of a point in time, every now and then kind of consideration. This is going to be part of the regular cadence of the business thinking and the management function of the property.
I'll tell you, those folks who are in buildings that have garages contained within the building itself have learned over the last few years how important these studies are, because we have so many buildings with issues. I won't get into the more detail than saying issues with relation to their plants and their garages and spalling and other structural concerns. So this is just a further extension. And I also should mention the plumbing, particularly the gas lines and requirements that are required by local law, but in general, and I think the folks at ACAM can comment on this. When you experience a gas leak or when you have to pressurize test gas lines, that's an incredibly expensive endeavor. And my understanding is that the guidelines provide that once you're aware of these things, you've got to report it, get that work done. And until that work is completed, your building is ineligible for a Freddie Fannie back loan. So it's much better to be progressive and be in front of these issues than to be chasing your tail.
Yeah, so Jack, just kind of extrapolating a little bit about the statements about being cleared versus blacklisted. And it's right here. What are some of the updated requirements? You've obviously gone into detail, but how often do buildings need to, for example, get a reserve study in order to start this whole process?
Well,
Yeah, so
go ahead. I was going to say that Orest may be better for this than Jack, but I think once you have that report, the question you're asking is how often should it be updated? Okay. My legal response would be probably every 5 years, but I'll let Oris answer the question.
Yeah, so that was in the past the industry standard that the reports would be updated every 5 years. But within these guidelines, and frankly, prior to these guidelines being released, Fannie Mae and Freddie Mac outlined what their requirements were, which are that a reserve study can be no older than 36 months old.
Wow.
So 3 years old. So every 3 years, we're going through the same properties and going back to the properties and comparing the initial reserve study and work that was to be performed to what the condition of the property is right now, and whether or not that work had been performed, looking at their bank accounts again, essentially creating a new funding plan for the development that could increase or reduce the reserve collection based upon that 3-year inspection of the property.
So, Art, that's a good segue into saying that if you're a co-op and you're borrowing money, make sure you take out a substantial line of credit with it, because 3 years later, as I've now learned, you may need to spend some money to keep your building financeable.
That's correct. And, with the local laws in New York City and the, new requirements and energy requirements that are coming,
yeah,
there are an enormous amount of cost that some buildings are going to have to take on in order to comply, right? So, that is something that you don't want to do this piecemeal, meaning that, in many ways, you want to look at those costs, what's coming down the road, what you're going to have to do based upon the condition of the property, what repairs have to be made, but also the repairs that have to be made in accordance with the new local laws.
Oh, well, we didn't mention it yet, but the ineligible provisions don't only require pertain to significant deferred maintenance, but if you have any kind of an order of an unsafe condition, whether it be from your architect, engineer, or from a city agency, okay, that will also render your building ineligible.
That's correct.
Can Mark or can one of you get into more detail on that?
Yeah, so it's all about habitability, right? So what they really want to make sure of is, number one, correct, you're entirely correct, right? If there is some sort of order from a local or state municipality outlining that there is some sort of condition on the building that has to be repaired, or maybe some sort of emergency condition, that has to be dealt with, and that is grounds for putting a building on the unavailable list until it's rectified. The question we always get is, well, how do you get off the unavailable list if this is the case? Because this could be triggered by local law 11. This could be triggered by several different, various different municipalities or orders that are placed against the building. And the way to get off of it, and it's, I think one of the crux of some of this conversation is Fannie Mae has a process that's called the PERS approval, stands for Project Eligibility Review Service. And Fannie Mae will review the development in its totality, the bylaws, the budgets, the reserve studies, the balance sheets, last 2 years financials, and determine whether or not that building meets the eligibility criteria, and will furthermore look at those issues or orders that may have been issued by the state. And if they feel like the building has then become compliant and done the work to remove those orders or those emergency orders and notifications, then they will grant a building that PERS project approval, which is essentially a green light for every single lender in the country to lend in the building for a period of 2 years.
Right.
So
Mark, or maybe Mark, or the fact that they're called temporary requirements, do either one of you actually believe this is temporary, or it is kind of phasing us into the reality of what will be the future?
I don't see it going backwards.
Yeah.
And what I was going to say to your question of frequency, so from our perspective, I'm based in California, but we serve nationally. There's different requirements in different states, and we've been talking about Fannie and Freddie. There are many municipalities and local statutes and state statutes that require annual. And there's been a lot of talk that legislatures and other regulators in various states may increase. If it's not at that annual cadence, that it may be increasing in other states for that matter. So there's also state requirements in addition to what may be happening that'll drive that frequency. But the thing I want to reiterate with regards to, Oris, your point, When a reserve study is done, many times the idea was, okay, that's a point in time we've done that. It's very important that the boards realize that their fiduciary obligation is to spend the money based on that plan, not to stockpile the money. When you stockpile the money, two things happen. Number one is you're likely increasing the deferred maintenance because the maintenance has not been done, and that's cost growing at a proportionate rate given to inflation. But also what's happening is that when you are budgeting, that means your expenses are going to be growing. You're going to have to pay more going forward because this plan is a commitment to how much you're going to pay every year going forward. So if you don't pay as much this year, you're going to be adding more payments to the year subsequently, and it becomes an accelerating factor. And so the thing that's very important is you've got to look at that plan every year. You have to make sure that you're spending the money. And often what happens is a reserve study will be updated. It may not necessarily come to the property, but they will make sure that the spending has been done. They will come at a certain frequency to inspect. And part of what's happening as part of the Surfside task force is engineering inspection frequency is going to be increased, and also stipulations. So this coordinated effort between reserve studies and targeted engineering inspections will have a higher cadence to begin with. And the last point that I'll make with regards to this, we've been talking a lot about the model that exists today, which is replacing like for like. I'm in an older property, I need to update the roof. Local Law 97, with the energy efficiency requirements driven in New York, it's an opportunity to invest in the infrastructure, reduce operating expense with this one-time capital expenditure. So this is truly the fiduciary opportunity to invest in your properties and to get those capital obligations and spend that money and get those loans.
I think that's a great segue also into discussing board responsibility, obligation, and risk in relation to all of this. Because as discussed earlier, lenders are going to ask questions and take a good hard look at almost a diagnostic look at your building and your finances. And you as a board are going to be asked questions, and how do you address all that? And I can tell you, and I'm not an insurance carrier's attorney, but that with regard to your D&O insurance, what carriers like to hear is that you as board members relied on the advice of your professionals in making decisions. And we appreciate that people have different expertise that are on boards. Some are lawyers, some have finance backgrounds, some have construction background, all kinds of backgrounds. And that's terrific. And using that background in moving your agenda for your building is terrific, but you can't use your expertise in making building decisions alone. All right. And when it comes to these types of decisions, financial, construction, financing, the best thing you can do is consult with your professionals, whether it be your management team like ACAM, or whether it be with your law firm, your auditor, with firms that Arst and Mark operate, with your engineering firms. Get that professional advice and operate and make decisions based upon that professional advice. And you will, in relying on that professional advice and making decisions, as long as your decisions are reasonable, okay, you will not be challenged in the court system, all right, under the protection of the business judgment rule. So we're not looking to drum up work here, but I'm suggesting for your protection, okay, utilize professionals in addressing the issues that we're discussing today.
So Jack, on that point, what can protect board members against personal liability if they're unable to satisfy these lender requirements, or they're having difficulty coming up with the funding to be able to put again, reserve and then have the financing available?
So that's a great question. And the answer is, the reality is you can afford to do what's necessary, but you have to then have your shareholders or unit owners confront you and say, why did you do this? Okay, at this juncture, it's almost become irresponsible. Your big risk is if you do not do something, not if you do something. And what Mark is suggesting is that doing something now is actually cost effective. All right, and it also brings you into the next century, technology-wise, energy efficiency-wise, compliance with local law-wise. Okay, and what Oris has explained is that you can get a report that kind of gives you the footprint, the outline of what you need to do. And then I think information is powerful. You need to communicate with your unit owners and your shareholders and say, hey, look, this is the new lay of the land. This is why it's happened. And this is what we have to do in order to make our homes financeable, and in order to be able to sell our apartments and have a buyer be able to finance a purchase. so we can maintain value. If we don't do this, we all hurt ourselves. So we're bringing this to you because this is the new world in which we live. We all have a responsibility, a fiduciary obligation as board members to do the right thing. But more importantly, as a community, we want to do the right thing to protect ourselves, our health, our safety, and our financial interests.
Thank you, that's helpful. And going particularly to local law 11, because that is on everyone's mind here. How is that viewed in conjunction with this new guideline? And New York City buildings need to comply specifically with many local laws, and that obviously is being factored by insurance companies. But for example, I believe you said this before, but if you are not, if you are considered an unsafe local law 11 facade, then you are obviously, I believe is what you said, not able to get a loan.
Yeah.
So what are I guess the nitty gritty when it comes down to local law, particularly local law 11?
So there's a lot. I mean, there's a lot that could trigger, the unavailability of lending within a development. In any instance where the habitability of a unit or a block of units or the enjoyment of life within a building is somehow in jeopardy via a local law inspection, and a result of that inspection and a direction of repairs or maintenance that has to be performed, you could pretty much guarantee that in that instance or in those instances that mortgage financing is going to be virtually impossible to obtain in buildings that have problems like that. Now, there are exceptions to every rule, right? So if there is a facade issue and it has been worked on and it's in the middle of being worked on and the board has enough capital to make those repairs without creating some sort of financial issue for the rest of the unit owners, then that's a project that is a contender, that's a building that's a contender for a submission back to Fannie Mae for a global approval on the site. But on the face of it, what you're going to see is a lot of developments because of local law 11 that just become unfinanceable.
So many of our managed, so just on the local law 11 part, many of our managed properties are designated under the SAFE and with a repair and maintenance program. And as you said, they're in the process of making the repairs. What do they need to obtain from the engineer, architect involved to make sure that they have the proper documentation to say that this is what the SAFE with a repair and maintenance report indicated, this is what we're doing, and this is how long it's going to take? Aside from the obvious with the report and the contract, is there anything else that they need to start asking of their architects and engineers to document?
When the repair work is done and what stage the repair work is in. So that's almost the follow-up piece. So if work is in the process of being performed, what percentage of the work is complete? What still has to be done? Those are the things that a board can obtain from an architect or an engineer who had inspected their property for local 11. The capital piece isn't there though, right? Because you can't outline that, okay, well, these are the repairs that are being performed, but right behind them, there might be, 40 capital projects that have to be done in the building. So I would argue that you really need an analysis of the building in its totality, in addition to the local law 11, work that or inspection that has been performed. I think that's the only way to kind of cover everything and make sure that you have mortgage financing available. But to answer your question very directly, Najo, because it's a good question, boards are going to have to go back to the engineers and architects and get that summary of, what percentage of the work is performed, A, and B, whether or not this work is impacting habitability of any of the units. And that information in many instances is going to have to be included in a reserve study to outline what that, the likelihood of future financial contributions or additional special assessments or what the future reserve contribution is going to be based upon that work and future work that needs to be performed.
Or just to expand on Ojo's question, so if a building has a safe with a repair and maintenance program, okay, that's not an unsafe building in and of itself, right?
Nope.
But I
Correct.
think we should add to that, that the guidelines don't put restrictions where you're doing ordinary maintenance. They anticipate that
correct.
buildings will have ordinary maintenance, and they also don't apply if there's a one-off. For example, there's a pipe burst in a particular apartment, or a fire that affects 1 or 2 or 3 apartments. That's not what this is all about. It's, as R said, a more comprehensive overlook of your building to make sure that the major components of the building are operational, safe, have a and that there aren't habitability issues. That
You know what a good example of that, Jack, is, Jack? An HVAC system, right?
Yeah.
So in the guidelines, it states that, if you have issues with your major mechanical components, that you're ineligible for financing. But we have spoken to Fannie Mae and Freddie Mac over the last couple of months. And, if you have an HVAC system and the air conditioning wasn't blowing really cold during the summer, when are you going to fix that? You're going to fix that during the winter. If you're fixing an HVAC system during the winter and it's not being utilized by the building, that is not a reason to go on the unavailable lending list. So there are some caveats here to what we're outlining. They're few and far between, but there are some caveats where you can convince the agencies to continue to lend in the site.
big picture, everybody. If I was advising a client, and we're getting a memo out very shortly on this as well, at your next board meeting or two, put this on your agenda, right? Put this on your agenda. And I find it's much better to be in front of issues than being reactive to issues. And so speak with your professionals and put together a plan of action to address these guidelines. If you walk away with nothing other than that, I think this would have been a successful discussion.
And Jack, if I could add a second point to that is, put it on your agenda next meeting and have it being a recurring agenda item.
Okay, that's right.
Because to the point here, as we're talking about Fannie and Freddie, there are many other things that are going to be happening, but just on Freddie and Fannie, notice how they said their guidance was temporary. I think behind the scenes, they're still working to figure out the details. There's still forms they're pulling together for documentation. The edge cases have not been determined fully yet, as Doris and you talked about. I think the main principles that we can impart to the board members and our fellow members in the community here is, look, the goal is about mitigating risk and understanding what that risk is, and then financing and being able to pay for that in the appropriate way. And so as long as you approach with the mindset, is this a systemic risk? Well, changing the HVAC right now is not a systemic risk, but if the facade or a structural concrete issue, that's a systemic risk that we should be really worried about. And then how do we track that? And then what is the risk? And then how do we finance or de-risk it? And I think those are the two core principles I would urge people to continue to keep in mind.
Thank you. All right, so because I think several people are confused about the 10%. Are you recommending that 10% of the operating budget be committed to capital reserves or repairs each year? And if so, is there a limit on how much can be accumulated before taxes on reserve earnings pop up?
Interesting. So the second question I'm going to defer to somebody else on the board. But the first question, let me outline it. So the guidelines specifically state that Fannie Mae's guidelines specifically state that you need a 10% line item in the operating budget that's collected year over year for reserve. And that's the only way that mortgage financing will be made available unless the project has a reserve study and funds whatever the reserve study prescription is, whether it be lower or higher than 10%. Most of the time, dependent upon the components and the age of the building and how well the building has been maintained. We're seeing in the New York City market that, just because of the sheer size of the budgets, because of employee costs that are included in the budgets, that the reserve study will identify a reduced reserve contribution that is less than 10%. So many boards, look, it might be 8%, it might be 7%. There are instances where it's 12 and 13% of an operating budget. But what we're recommending is that the board, at minimum, understand that they're going to have to put, and may have to put, as much as a 10% line item in the operating budget. But they will likely have to do a reserve study on these buildings to figure out what the right reserve contribution is. And more importantly, defer their risk or push their risk onto the professionals performing those studies. And that's, at least that's one of the things we really didn't cover here, which was what, how does the lender find this stuff out, and how do they know this about the building, and how do you deal with it, and what is the risks for these board members when answering these questions on the lender questionnaires?
The second question was asked, I guess, is if the building operates with a surplus, is that taxable income? Is that, at least, was that the question being asked?
Sorry, let me check. So the question for the second portion, because there were several that were all around the same type of question. This particular question had asked, apologies.
It came in at 6:51.
Oh, okay.
If that's helpful.
Here we go. Thank you. We've gotten quite a few, which is great, and we appreciate it. So are you, yes. Is there a limit on how much can be accumulated before taxes on reserve earnings pop up?
Yeah, I think the question is going to whether, if you operate with a surplus, is that a taxable event? Mark, do you know the answer?
Yeah,
to that?
I can address that briefly, knowing that we're sort of at the end of time. There are basically two elements. Technically these properties should be considered a mutual benefit nonprofit corporation, whether it's co-op, it's a TIC kind of relationship. As long as if there's excess revenues collected, whether it be operating or whatnot, there are tax provisions so that you can basically declare to have that refunded back into the operating budget or to the budgets of the property, so there's no taxable implication. That being said, if monies were being put in interest-bearing or some sort of return-bearing account,
That's different.
there is a taxable income impact. If, let's say, you had it in a CD and there was interest that was made on that CD, that is considered taxable. Now, I think given Surfside and other things, the broader government is looking at maybe ways to not penalize these kind of shared properties and make the incentives for saving the money basically for the rainy day. But that doesn't exist yet.
My advice would be to speak with your accounting firm, your auditor, and further discuss that if you operate with a operational surplus.
That's the appropriate professional for sure.
Yeah.
Question, so should the 10% requirement be less the property taxes?
For in a cooperative?
Yeah, so I believe so. Their property taxes,
Yeah, it would be for a cooperative.
Okay, only in the cooperative. Yeah. So the answer is the way the guidelines are written, it's 10% of the operating budget, and there's nothing backed out. And of course, there lies the problem, right? Because in operating budgets, you do have a substantial amount of taxes that are collected. You have a substantial amount of income in many buildings that's paid to porters or doormen or individuals who are working within that building that you're reserving on, that it really doesn't make sense to reserve on. So this is again the reason why establishing the appropriate amount of reserve is important, especially in a New York City market or even in a Florida building where you have a 500 unit building and you have 20 staff members. It still has a great impact on the collection of reserve if you're utilizing that 10% number as the guidelines outline it.
So that's a reason to do a report, right? And request an analysis by Fannie or Freddie and request a waiver.
Correct.
Yeah.
So how quickly do boards need to obtain a reserve study in order to be in compliance?
Well, so technically, they either needed a 10% line item or a reserve study in place by January 1st. That's how quickly these guidelines came out, and that's how quickly this has changed. Now, and it's just as quickly, meandering through the lender world, meaning that on January 1st, several new questions were added to condominium and cooperative questionnaires. That speak specifically to the condition of the building, that put board members at increased liability if they answer these questions without some sort of engineering report behind it. So and a reserve study doesn't happen overnight, nor does a Fannie Mae project approval. A reserve study can take 60 to 90 days, sometimes longer. Some of our competitors in the market we're seeing that are pushing reserve studies out for 6 months because they're so busy based upon these new guidelines. Typically we could get them done in 90 days at worst, sometimes less. So it's something that's almost something that has to be addressed at the next meeting.
Or can I comment on that? Because a lot of what boards may also do is say, well, how much each of these reports going to cost from different professionals, and look to go with the least expensive report, which may end up being the most costly report. So I suggest that you really work hard at making sure whoever does the work for you, okay, is giving you what you really need, not what's least expensive on its face. But
there's a lot of, you get what you pay for if you're not careful.
Yeah.
And Boris, can you comment on the concept of a draft report versus finalizing the report?
Yeah, so over the years, there's been this, thought process that a reserve study, and there was actually the AICPA wrote a letter about it, I think in the 80s, that reserve studies, should be, a board should really look at a reserve study, thinking about getting a reserve study very closely. That was a different time, because what they were worried about, that if a reserve study outlined that a repair had to be made and the repair wasn't made, then there could be increased liability for the board. And a lot, we live in a very litigious state here in New York, that a lawsuit would be brought against the board based upon a repair or a maintenance item not being made or not being performed. So those, that thought process is, certainly predates these new guidelines, certainly predates Surfside. So there's a different mentality in the marketplace. But what was thought to be the appropriate reaction to that is to obtain a reserve study, follow it because it was the right thing to do, but always leave the reserve study in a draft format and never finalize the reserve study, because the agencies, as long as a board was following the reserve study in a draft format, they would accept it. That's still true today. A reserve study doesn't have to be final for an agency to review it and accept it. So we still have many, many, many boards and buildings that obtain a reserve study and don't finalize it and keep it in a draft format.
Great, thank you. Okay, so I think we can continue to go on about this topic, but I know that there are a lot of questions, how are we going to handle this from an ACRAM perspective? And how can we help you, the board members? So I think what would be great would be to get to our Q&A question section. Please feel free to ask any questions that you might have right now. We'll answer them as best as possible. And then, of course, if something clicks later today or tomorrow or whenever, please feel free. We'll have all of our information after this evening's event, and feel free to get in touch with us. So we'll get started with our questions. So starting, I guess, with the top. How do we accrue reserves for capital replacements without it having it trigger taxes on profits?
Well, I think we talked about that. I'm sorry, go ahead.
No, that's right. I think we did talk about it with the tax issue that was outlined by Jack and Mark.
Okay, if that person still has questions, then we'll refer to it. And all right, so why should we demonstrate that we have adequate reserves if the intention is to borrow for capital replacements? So
the answer is on that one is that, again, I think we answered this as well earlier on, but it is viewed completely differently. A special assessment is viewed completely differently than a loan to a condominium or cooperative development. And the reason is the term that you can obtain for a loan. Frankly, after listening or after being involved in this presentation, I feel like I should, come back in another life as a lender, because I think they're going to do very well in the future. But the agencies look at the long-term nature of the repayment via a loan as different from a special assessment that might cause financial, hardship for unit owners.
So here's the question, Oris. So, or Mark, maybe you can help. A lot of times, particularly in condominiums, people want to pay boards want to pass an assessment to pay the debt service for that loan. Does that raise an issue, or should it simply raise carrying charges or maintenance?
Yeah, those are the, I'd say this, I see that happen. Look,
The reason, by the way,
that would be a,
is they want to be able to raise the basis of people's purchase prices. That's the
right.
theory.
Right. And the answer is, if they have that much capital that they want to do that, I would assume that those are the buildings that have an abundance of capital and have very well-funded coffers.
No. Take a
Or
typical
no.
condominium, take a condominium that's not so well-funded, and they
Okay.
need to borrow $1 million to do work.
Right.
Okay, and it's a 10-year self-liquidating loan, and they could either raise their common charges to cover the debt service for that 10-year loan, okay, or they can pass a special assessment for 10 years to pay the debt service for that loan. Does it matter under the guidelines?
It actually does. So just
Right.
calling it a special assessment triggers the problem.
Exactly.
Right. So sorry, I misunderstood the question. So yeah, so just calling it a special assessment triggers the issue. And then we're back in this vicious circle again of having to define what the special assessment is. They're going to have to raise their common charges.
And what I would say to that particular point is, look, if we break it down into the semantics, the one is to understand what your obligations are, and the second is how do you want to finance those obligations. And in particular, there's properties where, you know, having special assessments not only are problematic because they require votes, and if you have a series of special assessments, the more that you have, the more votes you have to have, and the greater likelihood that there's not going to pass. So here in California, I'll just give an example. There's a property here that is having to redo building envelopes. They're going to do a $13.2 million loan, as opposed to 8 special assessments over the next 12 years.
Yeah, makes sense.
Yeah, it makes sense.
All right. Okay, so this is geared towards Ajo. How will ACAM assist boards in developing strategies, you know, and responding to these new demands?
Sure. And, you know, there's a lot of aspects to that question, especially coming from the managing agent. First and foremost is gathering the information, which is what's happening now and what through the memos you'll be receiving. The other aspect of it is gathering the professionals, because every building has its own specific nuances with regards to financial position, structural integrity, etc. So each building, nobody could give a broad stroke on what everybody should do. Here are the 5 steps. Everybody just go ahead and take that and you'll be fine. We have to zone in on each property, gather their professionals, the individual professionals, the attorney, the engineer, the CPA, and really dig into what needs to happen for that property specifically. And ACAM's job and role in that is to quarterback that and to make sure that we source the correct professionals to help and assist our boards in making those decisions and determinations as to according to the guidelines.
Thank you. All right, is there a limit to how much a co-op can hold in reserve and the investments it can make with the same to keep abreast of inflation? I'm not sure.
I'll take question number 2 real quick.
Okay.
Okay, you're fiduciaries, and you better be real conservative in what you do with that money. You're not there to invest folks' money. So I would suggest dividing it up to make sure that you have federal insurance to cover balances, and the least or very low risk, like CDs type use of the money. Okay, don't buy options.
I was gonna add to that. It's been a topic that's come up a lot, and to your point, I think there's the business judgment rule. There's also the prudent investor rule that boards can follow. As a fiduciary, it is also, let's put it this way: if you were to stick all your money in the mattress, one could argue that that's very safe, or basically getting 0% return, but there's high inflation. That's where you may raise the question of how much do we want to save for how long? If I have a 30-year obligation, may I want to finance some of these things and get a loan because of the inflation trade-off? Those are some of the things that, again, is what is the obligation? How do you want to finance it? But to your point, the general recommendation is have an inflation hedged investment strategy, but you have to know what inflation you're looking at.
Right. Are the insurers paying attention to the Fannie Freddie list of non-conforming properties?
Absolutely.
And there's a twist on that, right, Ars? Because if your insurance carrier raises issues, that might also trigger some issues with Freddie and Fannie. So maybe Ars, you want to comment on that further?
Yeah, so we've been discussing this throughout the industry, specifically with the New York State Attorney General's office over the last couple of months. We anticipate that they're going to have some sort of, comment on the Surfside as well, and maybe we'll include some sort of recommendations or requirements in it, that will likely mimic these guidelines for Fannie Mae and Freddie Mac from what we're hearing. But insurers have also essentially been talking about increasing costs for buildings that aren't compliant, and in many instances not wanting to insure any building that has structural issues. We're seeing it in Florida like crazy. The increase in insurance cost is astronomical for buildings that are over, I think, 25 years old, without some sort of major structural component repair and replacement.
And my understanding is that project eligibility waivers will not be given because of issues raised by insurance carriers going forward.
Correct.
Under new guidelines.
There was a process in the past where you could submit an individual loan as a lender. You could submit an individual loan if there was an insurance issue directly to Fannie Mae and have them approve and provide a waiver for that individual loan.
Yeah.
That is no longer the case. They've done away with that practice, correct?
Yeah.
And to your point, look, I mean, anyone who has looked at their insurance policies generally across the country, commercial or individual, there's been a sizable increase in general because of just broader issues in the insurance market. Surfside is accelerating the conservative nature of insurance, given a lot of also the category factors that have been becoming more and more critical. It was very anecdotal with several insurance brokers in Florida, for example, but a few weeks after Surfside, properties that would have been covered from 1960, those carriers said nothing before 2000. I won't look at those. I won't source them. And many people are now going to the insurer of last resort, which is the state of Florida. So again, as we talked about, this is an evolving situation. These are two of the dominoes. Expect more, particularly on the insurance side. And again, the insurance companies look at reserve studies. They look at your operating budgets. They look at if you're following your maintenance plan. Are you basically the equivalent of a safe driver or not? The insurance companies are paying much more attention to that.
Right. They look at your physical plan.
Yeah. And your behaviors. Have you been keeping up with your fiduciary obligations?
So in this case, this building just refinanced their mortgage and now have money in the bank that they put into a capital reserve account. This capital reserve should last about 10 years based on their IPNA study. Does this 10% reserve requirement still apply to them?
So the answer is technically yes, that they're still required to put a 10% line item in the operating budget for reserve, even though they have that capital, and that is as the guidelines are written. If they obtained a 30-year horizon study and it outlined that capital that was in their account that they just borrowed was enough to fund the repair and replacement costs for this year, next year, the following 10 years, then it's likely that the reserve contribution would be incredibly low, that the reserve contribution reported in a reserve study would be incredibly low. But without that, you could not submit that project to Fannie Mae for an approval or a review. So you would need the reserve study to send it to them, or you could put a 10% line item and overfund the reserve, which what looks like is
that's not what they want to do. Horace, it's got to be 30 years.
Yeah. So the studies, so there's new guidelines that have come out that they want to see a 30-year horizon on the reserve components. Yeah.
To that point, this particular building, they have an IPNA report that gave us an estimated cost of repairs, replacements, corrective actions needed over a 15-year term. Is that the same as a reserve study? And it sounds like that might negate. It's not the same, and
it's not the same, and it doesn't utilize the essentially. Typically, those reports don't have an inflation amount, built into them. Sometimes they do, but they don't have a 30-year horizon, and that's what the lenders are most concerned about because their loans are for 30 years.
So then, in the same case, the capital plan would have to have a horizon of what?
Your capital plan is a 30-year capital plan.
30.
You want to, yeah.
Okay.
Oh.
So, yeah.
A lot of developments get property condition assessments in lieu of a reserve study. They're cheaper. They don't outline what the current capital is. They don't outline. They're done by professional engineers in most instances. I should say in some instances. It's not always done by a professional engineer. But those reports are typically used for commercial financing. They're not utilized to develop a plan for maintenance and funding for component repairs. So they don't really work in this scenario.
Mm-hmm. Okay. Can annual contributions to reserves or funding of annual debt service on a capital loan be added to a condo unit owner's tax basis in his or her unit?
That's a Mark question all the way.
All right. So the short answer is it can be, and it depends, which is true of many probably answers you might get. But let me break it down because we've actually done this. So essentially, there is two parts of it if you want to think of it from a condition standpoint. Number one is, were these capital replacements or improvements? Normal repair and maintenance does not apply. So the trick is you have to be able to understand, let's say we redid the chiller system. We replaced the roof. So it was a capital replacement. That element can apply for a cost basis enhancement to the property. Again, this is pure IRS tax laws. The trick is that you have to have the documentation, the accounting that's auditable to be able to show that. So if you, for example, had a special assessment and you have $1 million for 10 units, then you each wrote a check for 100,000. Well, then the accounting for that is relatively straightforward and you have the documentation to prove that you paid that. Where it gets complicated is that if you've been paying incremental dues over time and then you pay the check and then the association. So the short answer is you can do it. It just needs very good accounting and due diligence to be able to get that information extracted.
Now, also, Mark, to piggyback on that question, because we discussed the complications of an assessment versus an increasing carrying charge to pay debt service, if a condominium was to borrow money over a period of time and raise carrying charges to pay off that debt, would people's interest in the condominium, their percentage of interest, build as that debt was paid? Would they be able to accumulate equity in a like fashion? Or is the fact that it's being paid with common charges versus the word assessment matter?
It's a very interesting point. There's some debate on that, but the broad strokes are that if you were to, let's say, the expense of the replacement, again, to keep things easy, was a set number. There's some debate about whether the interest in the carrying charges of that debt service could also apply to the cost of the capital improvement.
Well, that's interesting. Yeah. Yeah.
And so that is where things get kind of interesting with regards to, and there's some debate. Again, that's where your CPA would be the best professional. It may also become, I don't want to overstate this, but it may be a question of interpretation and of that CPA. And the conservative may say, no, don't include that, but someone may say, yes, you could. So again, that's where your professional would come in and give you the right guidance.
Are lines of credit readily available for large co-op buildings?
I can answer that, or I can take a stab at that. The answer is often yes at the time you're financing or refinancing your building. If it's subsequent to a refinancing, it's more difficult and often not available unless you're going through the current lender. All right, so two things. Number one, I always advise that it's much less costly to obtain a line of credit, even if there's a yearly small cost in maintaining that line of credit when you refinance, then they open that door 2, 3, 4, 5 years later. So you're better off doing that now. Secondly, if you're not going to do that, at least build into your loan document, negotiate with your lender the right to either a line of credit or a second mortgage. And that is often something we can negotiate with lenders.
Thank you. All right, so our condo established a capital reserve assessment many years ago in the amount of approximately 10% of our annual operating expenses, which is collected pro rata on a monthly basis. Given this has been working nicely, does our condo also have to do a capital reserve study and have that prepared One benefit is to smooth out the cost of owners over time, as opposed to taking out a line of credit, given the cost that a credit line would be primarily serviced by only applicable owners at the time of draw.
The answer is, no, it's a great question, and like, so essentially they've been funding 10% in their reserves, or collecting 10% every single year on a pro rata basis. And do they have to now get a reserve study? The answer is, technically the answer is no. You could have a 10% reserve line item and be in alignment with these lending guidelines. The problem that comes up is really about liability. These additional questions that are being asked about structure, and whether or not there's a structural issue with a specific building, or if the board is aware of any issues that may cause a problem with habitability, could create lots of liability for board members. And I'm a belt and suspenders guy.
And bow tie apparently.
And a bow tie apparently too. Yes, it's true. I would rather have a professional answer that question than a board member. Then I would answer that question personally. I would rather have an engineer answer it.
Horace, isn't that the same question where I mentioned that sometimes people would say 3-4 months is sufficient? The answer is, we don't know.
Right.
We don't
Right.
know.
And just to unpack, I think a little bit more on the 10%, because I think a lot of people get themselves really caught up in that number. And Horace and I have just talked about this many times. 10% might be incredibly high in New York, but it is abysmally low in Western states where there's no staff. You can see an older property that should have a reserves contribution correlated to OPEX on the order of 30 to 40%, because there's no staff and it's an older property and there's a lot of maintenance to be done. I equate the 10% to say, let's say I was just coming out of school and I was 3 years from retirement, and the IRS was saying I should put 10% towards my retirement, regardless of whether I was going to live in my current standard or I wanted to, embellish my retirement. That 10% really doesn't take into account how much I have and how much I need. So when we talk about that 10%, I applaud that group that's already following that discipline. So you're meeting the Fannie check mark. The question is the 10% enough? If you're in New York, it might be, but wouldn't you like to know when that next big expense is going to come in, how much you have in the bank? And you can position that also when you sell your units about how well you're prepared for these things that might be happening.
All right. And again, just to clarify, if a condo has the 10% already reserved, do they need a reserve study?
They,
Not under the
yeah,
guideline, not necessarily under the guidelines, but they may need it for other reasons.
I wouldn't want to answer a question about the the likelihood that the condition of my infrastructure is any question about the infrastructure of my condominium development without some sort of engineering study and or a reserve study. Yeah.
All right. Thank you. We're finishing up here, so I'm just gonna ask a few more questions. Do Fannie Mae and Freddie Mac view a condo's use of existing cash in a capital reserve instead of a new common charge income or capital loan proceeds as satisfaction of the 10% reserve requirement?
They do not. It is a black and white statement or guideline from Fannie Mae and Freddie Mac that you must have an ongoing collection of 10% every year, or a reserve study to show that what the appropriate amount of reserves should be. So it doesn't matter, in the example I gave before, we have a building that in New York City that has $22 or $23 million in capital sitting in an account. Well, they have that money, but based upon these guidelines, they would still have to fund the 10%. They're getting a reserve study, so they don't have to fund anything over the next 30 years because you can repair all the components with that money over the next 30 years, 2 times over.
All right, thank you. So now we'll just end with this last question. So a resale certificate in the state of Texas is provided on all purchases and gives specific information about the project that's being sold. It tells them about special assessments and any violations and pending litigation. Does the resale certificate in New York also provide this?
Jack, I think I
I can tell you that you're required to provide a fairly detailed statement to a prospective purchaser unless it's waived and you give up about $500. Okay, and so pretty much all sellers, once the contract, is being negotiated, are advised to forgive the $500 and say nothing. Okay, I'll add to that we don't do a lot of closings for purchasers because as a condition of representing a person for a purchase, we require that we do due diligence that many people don't want to pay for. And we'd rather just walk away and not be involved. So I don't know that we have the same laws in place as they may have in Texas on many things. But in all likelihood, if you're selling your apartment or your unit, you're gonna walk from the $500 and not make representations. That said, you're still obligated to live up to the representations that you make in your agreement, whatever that may be. More often than not, the contract says you're purchasing as is. You've done your own due diligence. So that's my broad answer, and I would suggest that you speak with your independent counsel if you're looking to sell your place.
Great. As a former broker, I agree. All right. And the last question, which I know many people want to know, and even if it's kind of a range, how expensive is it to do this reserve study, and can it be financed?
Yeah, so there are many types of properties in New York City that fall under, condominium and cooperative ownership. And that includes, condominium developments that have commercial entities in them and hotels next to them. And it includes developments that are, 5-story walk-ups that were built in, the early 1900s. So it is a range. On average, it costs around $8,500 per 100-unit development. That number can go up or down if the reserve study is required to include some of the commercial components in the building. If the building is smaller, it might be, a little bit less, but typically from 50 to 100 units, it's around, $6,500 to $8,500. And then it can get, incredibly expensive, probably up to $25,000 or $30,000 for a 400 or 500 unit building with a hotel component and commercial components on the building as well. On average, across New York City, it's around $8,500 to $12,000.
All right. Well, thank you all for your time.
Elise,
Yeah.
just 1 second before, because I know a lot of our clients are going to have tons and tons of questions.
Yes.
I want to ensure that we communicate that we will be providing information on what the guidelines are, what the steps are over the course of the next week or so. And because this is a fluid situation, we'll be continuing to update that as well. And I just wanted to personally thank all the panelists, Jack, Orest, and Mark, for joining us today. And Orest said that any ACAM property would be free anyway. So I'm just kidding. So
all right.
we will be working with all the professionals based on the economies of scales to negotiate bulk rates on a lot of the services that we need for our clients in this regard.
So you mean this wasn't it? This isn't all we're doing for a client, just this one impressive?
No, this is going to be
moment in
ongoing.
time?
This is going to be forever.
Okay.
Yeah.
Obviously, yes, it's very important. And obviously we want to make sure that we keep abreast as anything comes up. But and thank you, Ajo, for making sure people are aware of that. So Jack, Orest, Mark, and Ajo, thank you.
Thank
so
you
much.
very much.
Thank you for having us.
Thank you.
Appreciate everyone's attention.
This is definitely, I think, a big change. So it's a lot to digest, but it's very helpful information. And all of everyone's information is listed here, but feel free to email us at ACAM for further information as far as reaching out to these individual contacts if you didn't write it all down. And this will be recorded. So if you want to go back and remember this moment, you can. But anyway, thank you so much. We really appreciate it, and stay well.